They pumped the Nikkei past 71,000 on Bank of Asia's 15% upside call, and then they rug pulled at 3.5% in a single session. This isn't a coincidence. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. The 69,700 cluster is the line that separates a healthy correction from a liquidation cascade, and the herd is positioned exactly wrong. I've been on the desk for over 2 decades, and moves like this are where volatility turns into profit, if you know which side of the trap you're on. Let's get into the chart. Instant market verdict. The session bias is a fade. I'm fading this panic into the daily support structure. Higher timeframes, monthly, weekly, daily, are all still screaming strong buy. This is a pullback inside a bull trend, and until we lose 69,400 on a daily closing basis, I am treating this sell-off as a back-the-truck opportunity. The single invalidation level that flips my entire bias is 69,400. Write this number down. If we close below 69,400 today, the entire structure resets and the trend shift becomes real. Right now, the herd is chasing the break lower on the 1-hour chart, shorting into a 60 RSI that has already reset, while the daily trend is still pointing up with a MACD above 2,100. That is a textbook liquidity grab. The Nikkei is the world's ultimate risk-on barometer, and when it sniffles like this, global equities catch a cold. So I'm watching the yen, I'm watching the S&P, and I'm fading the fear. Now the technical deep dive. Start on the weekly. The 200-week moving average is way down at 56,170, climbing, and price is thousands of points above it. This is a runaway bull trend. The weekly MACD is positive and accelerating. No bearish divergence. The 20-week moving average is at 68,177, and that's the first magnetic level where this pullback could run out of steam. Drop to the daily. We opened the session above 72,000 and we are closing around 69,788, a massive bearish engulfing candle, but the daily 20-day moving average is right at 68,177. That's less than 1,500 points away. The daily RSI printed 60 earlier today. Now it's cooling fast. The stochastic is still pinned at 97, which means this sell-off was an overdue overbought flush. The Williams percent is sat at -4, essentially buried and overbought, so this unwind was a mathematical certainty. The MACD line at 2,140 is still rising. No cross yet. That tells me the sell-off is a momentum reset, not a trend reversal. The pivot point for the session is 72,178. That's the magnet above. Below, key supports. S1 at 71,520 gone. S2 at 70,351 gone. We are now testing S3 at 69,694. That's exactly where price is hovering as I speak. 69,694 is the make or break. The 60-minute chart shows a strong sell signal with price below the 5 and 10 MAs, but the 4-hour trend is neutral, meaning we are in a decision box. Here's what most traders miss. The 60-minute candle is carving a potential bullish divergence on the RSI. Price makes a lower low, RSI starts to curl higher. That's the fingerprint of a trap. The 4-hour 20 MA is at 68,800, also curling up, so the pullback is into a dynamic support zone. The 200-day moving average is down at 56,170, utterly irrelevant intraday, but the 50-day is 64,775, still thousands of points below, too far for a stop. So the real floor is the 20-day at 68,177 and the 69,694 structural S3. That band, 68,200 to 69,700, is where I want to be a buyer. If we lose 69,400 with a daily close, I'll flip short and aim for 67,000. But until then, this is a dip buyer's market. Now let's weave in the fundamental driver. The 24-hour news is screaming. Bank of Asia says 15% upside left for Nikkei in 2026. That is a direct institutional blessing, And they're not saying that after a 3.5% down day unless they see demand deeper in the book. Client sentiment shifted right as the index breached 71,000, and that's the tell. When retail gets euphoric at a round number, the market does the opposite. So we saw a classic bull trap above 71,000, a liquidity sweep, and now the algorithm is testing conviction. On the cross-linkage side, the yen is the puppet master. Dollar-yen is hovering near intervention whispers, and every tick lower in USD JPY tightens the vice on the Nikkei because Japanese exporters get squeezed. The 10-year JGB yield is still pinned by the BOJ, so the carry trade is alive, but any hint of a yield cap tweak could send the Nikkei into a deeper unwind. I'm also tracking the S&P 500 futures. They're holding their own gamma levels, which means risk sentiment isn't breaking, it's just rotating. The Nasdaq is flat, not collapsing, so this Nikkei drop is a localized positioning clearout, not a global risk-off event. My 1 to 2 week directional lean is bullish, targeting a reclaim of the 72,178 pivot, as long as the weekly close stays above 68,200. The event that kills this view is a BOJ emergency meeting or a sudden dollar-yen break below 145, which would trigger a correlated freefall. I don't see that this week. But I am watching. Do you think the Nikkei holds 69,400 this week? Comment yes or no. I'm tracking consensus right now. Alright, this is the section most people skip, but that's exactly where the money is made. Keep watching. I'm giving you 3 trade setups, from conservative to aggressive, with exact price triggers, stops, and targets you can screenshot right off the screen. Strategy 1, the sniper. This is the conservative play for those who want to catch the reversal with the trend. Entry trigger. A 1-hour candle close above 69,700. That shows acceptance back above the S3 pivot, confirming the liquidity grab is done. I'm setting a buy limit at 69,720, or entering aggressively on the close. Stop loss is 69,150. Just below the intraday wick low and a psychological 69,000 cushion, giving a 570-point risk. Target 1 is 71,520, which is the former S1 support turned resistance. That's 1,800 points. Away, a 1 minute and 3.1 second risk-reward ratio. Target 2 is the pivot at 72,180, another 2,460 points. Making this a 1 minute and 4.3 seconds a play if you split the position. Invalidation. Void if we get a daily close below 69,400. If that happens, the setup is dead, and I'm flat. This is the sniper waiting for proof of life before pulling the trigger. The sniper, conservative, entry, 69,720, 1H close above 69,700, stop loss, 69,150 take profit 1. 71,520 take profit 2, 72,180 risk, reward, 1:3.1R, TP1, 1:4.3R, TP2. Invalidation. Void if daily close below 69,400. Strategy 2, the active trader. This is for the mean reversion player who wants a deeper discount. I'm looking at the 20-day moving average at 68,177 and around 68,200 support. Entry. Place a limit order at 68,220, with a confirmation of a bullish pin bar on the 4-hour chart. Stop loss goes at 67,550, below the most recent swing low and below the 68,000 magnet, risking 670 points. Target 1 is the 70,000 psychological level. That's 1,780 points, a 1 minute and 2.6 seconds R. Target 2 is the S1 at 71,520. Once target 1 is hit, move the stop to break even and trail by the 4-hour 20 MA. This setup gets you in at the mean, where the herd is panicking. Invalidation. A 4-hour close below 67,800 voids the trade completely because it would mean the 20-day MA has failed as support. Type your Nikkei range for tomorrow in the comments now. Let's see who's aligned. The active trader, standard, entry, 68,220, limit order, 4H bullish pin bar, stop loss, 67,550 take profit 1, 70,000 take. Profit 2, 71,520 risk, reward. 1:2.6R, TP1, invalidation. Void if 4H close below 67,800. Strategy 3, the aggressor. High risk. Counter trend on a smaller time frame. If the S3 at 69,694 breaks and we get a 15-minute candle close below 69,600, I'm selling into the momentum for a liquidation run. Entry is a sell stop at 69,590. Stop loss is 70,100, above the psychological 70K and the 1-hour 10 MA, risking 510 points. Target 1 is the 68,200 demand zone, 1,390 points, a 1-minute and 2.7 seconds are. Target 2 is 67,000 even, a deeper support. This is a trade for the fast hands, only for those who can lose small and manage risk aggressively. If the price snaps back above 70,000 within the hour, you're out, no questions. This trade exploits trapped longs who bought the BofA headline and are now getting margin called. It's a vulture play. On-screen trading plan graphic for the aggressor, high risk, entry, 69,590, sell stop on 15M close below 69,600, stop loss, 70,100 take profit 1, 68,200 take profit 2, 67,000 risk, reward, 1:2.7R, TP1, invalidation. Void if 1H close above 70,000 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news, BOJ, US CPI, or unscheduled yen interventions. Stops are non-negotiable. This is how you survive to trade the next big move, close and retention loop. The single most critical level for the next session is 69,400 on a daily closing basis. Hold that, and the bulls are still in charge. Lose it, and the structure flips bearish with a fast move towards 67,000. Tomorrow, I'm watching the Asian Open gap and any BOJ jawboning. One word from Weta could accelerate this move. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.